The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. Bobby Rains here for our once every 3 weeks members-only workshop. We have our regular agenda this week. We'll talk about what's going on in InvestorsObserver, little market update, and then the rest is member-driven content, questions, site demonstrations, etc. As always, a reminder, if you send in questions ahead of time, they don't need to be far ahead of time, but if you send them in ahead of time, I can prepare slides. And we got a question from Jeff today who sent it in not super far ahead of time. It was earlier today, but I did manage to get a slide worked up about credit spreads. So if you're interested in doing that, you can do that at some point in the future. I think the only real what's going on in InvestorsObserver we have this week is the launch of the new stock page, which looks like this now, instead of the circles that you saw before. So we did that, and we've got text descriptions of what the scores mean. That was another thing people were asking about. And then that also necessitated a change on the option trade screener, or not, sorry, not on the option trade screener, the stock screener, in terms of having these bars here now instead of the circles that we had before. We like this. We think it looks better and is a little bit cleaner, and the page is a lot easier to use as well. So that is that. Let us know what you think about it, or any other things that you feel like the site is missing or needs could be improved, etc. All right, on to the market update. It has been an interesting 3 weeks. That doesn't appear to be the right chart. Well, it's not the right chart. That's the chart from last time. All right, hang on. Let me open the chart here. I'll just open it outside of PowerPoint. Sorry about that. I put together a lot of charts today, or at least more than normal, and so I missed one. Let's see, 1 year chart. Here it comes. There we go. Yeah, so you can really see the difference. Our last workshop was pretty much right at the top. Yeah, and now we are not right at the top. This is again, 1 year's, 1 year view. Every candlestick is a day. And yeah, we've had some really big candles of either color, long wicks. It's been pretty exciting to be watching the market. Maybe a little stomach churning. That's probably a better word than exciting. And yeah, we're pretty much, I think the current price is, I believe, below any price we've seen in the last 12 months. So moving to the next one. So this is 2 years of daily candles. You can see here, now we're talking, we're still down from the start of this 2 year period. But depending on where you got in, you may still have some gains. This low down here, I've seen other people talking about it, is probably not entirely out of the question. In terms of places we could get to, I don't expect us to get to that soon just because things are very, very extended. I think there's going to be some consolidation and a lot more of this roller coaster. But it's not impossible that Christmas Eve 2018 low comes into play at some point before we're all done here. But here is why it may not. So this is 3 years. We had to go back to 3 years to get some decent context in terms of what was going on. And you can see in sort of this area all through here. There's a lot of old support and resistance levels. Those may help. Also, obviously, some some other things, fiscal and monetary policy things, may help, which we'll talk about in a couple of slides. But from a strictly technical standpoint, there are some other support and resistance levels between here and that Christmas Eve 2018 low. All right, so I brought this guy back. S&P versus the yield on 10 years. Last time I think we talked about this, we were talking about how far apart those things had gotten. And they have really moved in tandem here recently. And treasury yields are just bananas. The federal government can borrow money at 1.3%. So that's the annualized rate over 30 years. And at 10 years, it's 0.73 roughly. Those are historic, like all world, like historical lows in terms of bond yields at that duration. Like there are some bonds in Europe that trade at negative yields, but for treasuries, it's absolutely unheard of. And I think a little bit of what we saw today, I didn't have an intraday chart. I may pull one up later. Was a little bit of just sort of exhaustion in terms of bond buying. People talk about panic buying, and that's really what we've seen in bonds is just people trying to get into bonds sort of as fast as they can. All right, so what else is going on? There's uncertainty everywhere. Trying to put stuff together today, and then various things kept changing. As we're doing this. So that's certainly interesting. No one really knows what the economic impact is, right? No one knows how hard the coronavirus is going to affect any one location, and also the scale of economic disruption is a mystery. We talked a little bit last time about supply shocks in terms of, factories in China were closed for a long time, and that was going to interrupt supply lines. That hasn't gone away, but we are looking at demand shocks now in terms of people don't want to go places and do things, and so now you're potentially getting caught at both ends there. The Fed cut rates in between meetings last week. That was kind of interesting. It was certainly unexpected. It's the first emergency cut since 2008. It was the first 50 basis point cut instead of a 25 point cut since 2008. Both of those things took the market by surprise, and I think maybe that was the point where the market sat up and started to take things seriously, because that didn't actually buoy markets. The Fed announced today they're expanding their repurchase facility. They could cut more. The thing there is, none of the stuff that the Fed really has in its arsenal can help the consumer or really do much for the market a whole lot right now, because the problem isn't financial. So in the financial crisis, flooding the system with liquidity really helps, right? Because what you have is a lack of liquidity, and the sort of gears that run the financial machinery sort of lock up. We're not at that point yet. Sort of as an example of why that doesn't work, the Fed sets interest rates for banks and things like that. So, sort of a weird rhetorical question you can ask yourself when you want to know if the Fed will help is, what is the rate at which banks can earn interest on excess reserves? Right, like what does that rate have to be for you to book a cruise right now? Right, like the question doesn't even make sense. So the Fed is there, ready to provide liquidity as necessary, but the Fed's tools aren't really applicable to the current issues, and that's why you've seen free fall since the emergency rate cut, is because it's not really going to help. The economic data that we've gotten lately is still actually pretty good, but economic data isn't forward-looking. All that stuff is outdated. It's from February. we actually had a workshop. We had one of these workshops since the reference point from the February economic data. The monthly employment situation report uses the week that contains the 12th as the reference period for their survey. And so we've had a workshop since the unemployment numbers that came out Friday were collected. So we'll talk a little bit about what to look for in economic news going forward. But really what the economic news we're getting right now means is we're starting from a good base, but because this is a weird sort of, outside shock that came in, it's very difficult to extrapolate from trends in terms of what we're looking at here. And yeah, there are some obvious pain points. I mean, well, right now everything is down, right? Correlations get very high when people panic. They just sell everything and sort it out later. In terms of where the damage is, it's pretty obvious: travel, lodging, restaurants, entertainment, all of those sorts of things are going to get hit hard. Yeah, we'll talk a little bit about that later. And then we also have the oil price war. It seems that Russia and Saudi Arabia are both willing to pump at a loss for a while. And it's kind of hard to tell who the target here is, right? Like Saudi Arabia would love to get back to OPEC, which was essentially a cartel that set the price of oil, because they could control OPEC pretty well. OPEC pretty much went along with whatever Saudi Arabia wanted. But since Russia came online and started producing a lot of oil, they've been calling it sort of OPEC plus, and so now it's OPEC plus Russia. And what happened in this instance is OPEC had a deal for production, and Russia said, we don't think so. So yeah, now Saudi Arabia and Russia in particular are both willing to just pump oil at a loss for a while. We'll see how long that takes, right? Like obviously you can't sell at a loss forever. And I'm not sure, honestly, like break-even points are a thing that talk about in oil. And so a break-even point is how much it costs to get a barrel of oil to market. And Saudi Arabia is probably still profitable on that level. Russia, I'm less sure about just because I'm not as familiar with Russia's oil sector. But Russia and Saudi Arabia also both fund their governments with the proceeds from energy. And so in terms of selling oil at a loss, essentially at the current price of oil, they're both going to be running deficits, and those are not countries that can borrow, right? Those are not countries that have, can borrow money for 30 years at 1.3% interest. They just don't have access to the bond market like the United States does. So Saudi Arabia may be targeting Russia a little bit. Saudi Arabia and Russia both obviously aren't really in love with the rise of fracking and lots of other onshore production in the U.S. The U.S. is largely, I don't want to say, independent seems, it seems weird to say energy independence. Like you're energy independent when somebody else can, some outside player can crush the price of energy in your country. But that's kind of where we are here. Fracking tends to have pretty high break-even points. And yet we know that Russia is willing to use energy for political purposes. They shut off pipelines to Europe several years ago because those pipelines went to Ukraine, and Russia has been in this war with Ukraine for a long time now. And yeah, Russia generally seems to be very interested in sowing uncertainty and discord around the world. So yeah, if they see a crisis, they're not afraid to jump in and use it to their advantage. So they're certainly willing to see a crisis in U.S. markets and try to add to that. And yeah, like I said, frackers tend to have high break-even points. It has in the past seemed like it's easier to scale production up and down than some other methods of extraction in the various shale plays in the U.S. Where the fracking happens. We've seen it in other cases in the last 10 years or so, since fracking really became a thing where the price goes up and fracking just sort of grinds to a halt for a while, the price goes down, fracking will grind to a halt for a while, price goes back up, and fracking comes back online pretty quickly. That had been sort of a buffer in terms of keeping us from having big oil price swings because that production can go up and down. And yeah, some of the fracking companies will likely fail. Unless Russia and or Saudi Arabia blink pretty soon. Oil at whatever the price is as of now is somewhere below $40, around $40. It's just unsustainable for fracking to run at that level. But the difference here from 2008 is the assets of those oil companies continue to exist, right? Someone will buy them. You can put a price on an oil reserve in the ground and you know what the value of that is. Now you have to adjust it for the current price of oil, but it does have some value. This isn't like the financial crisis where you had, bonds issued by companies that were, if not worthless, impossible to price. Oil in the ground is an asset that's pretty easy to price, and you can run all kind of models based on the price of oil. And there's some natural price that it's going to have to go back to eventually because, like I said, Russia and Saudi Arabia can't keep doing this forever. All right, so what to watch? We talked a couple slides ago about how economic data is all backward looking. Unemployment claims are a series that we've just sort of ignored for a long time. It's been very steady at plus or minus 210,000 every week. So that's a weekly number that comes out, and it doesn't lag by very much. So tomorrow morning at 8:30, that number comes out. We may start seeing an uptick there as service workers and other people get laid off. We'll see. It'll be interesting. But that is a pretty responsive, series of economic data and has a relatively short lead time. Another thing to watch for is more companies, pulling their guidance. Apple sort of kicked this off a little bit, pulling their guidance. Airlines and cruise operators have been doing it. American Airlines not only pulled their guidance, but they said they're cutting domestic flights by 7.5% this month and cutting international flights over the summer by 50%. So the airlines are just getting whacked here, and Boeing got crushed today for a lot of reasons. But yeah, so they can cut flights, and that means they don't have to pay gas. They probably save some in terms of salaries, but right, if you're American Airlines, you can't just lay off all your flight crews or lay off 7.5% of your flight crews even. So certainly flying planes that are empty, is wasting money, but not flying those planes doesn't save you as much money. Cutting flights by 7.5% doesn't save you 7.5% of costs is the point I'm trying to make here. It seems unlikely they can really cut costs necessarily in line with the number of flights they can cut. And yeah, cruise operators are also pulling their guidance. And yeah, so another thing to watch for is more unconventional monetary policy. The Fed upped its repurchase facility just this afternoon. Some things we saw in 2008 were things like swap lines across currencies, essentially letting countries trade, the central banks of various countries trade currencies in between each other as was needed in the various financial systems, just to, again, sort of keep the gears of the financial machinery moving. We'll see if that's necessary this time. I don't know that it will be because, again, this isn't a financial crisis, but that's another thing to keep an eye on. And then other unconventional monetary policy, quantitative easing. I don't know if the Fed would do that or try to do negative interest rates again. Either way, there's a lot of things they can do there. But again, all those things are sort of working on the margins to help keep the plumbing of the economy intact. They don't really do a lot for the actual problem here, which is people getting sick and also people not wanting to go out and spend money in the economy. And then, the big lever is fiscal spending, right? Like there's monetary policy and there's fiscal policy. And yeah, government's trying to put cash into the economy is helpful, right? Like giving cash directly to citizens is probably the most helpful in something like this. Like tax cuts and loan guarantees aren't useless, but they're a little bit less effective, sort of on a sliding scale. I mean, the people in our economy who are sort of at the bottom in terms of not getting paid very much, being hourly workers who don't have sick leave, a payroll tax cut isn't going to help that person very much. In particular, if they don't get paid for not going to work and they can't go to work, a payroll tax cut doesn't help that person at all. So it'll be sort of interesting to see what sort of spending packages get put together, and also what form they take. But yeah, this is what people talk about when they talk about counter-cyclical fiscal spending, is spending more in bad times, and then you can ease back on that in good times, or at least run smaller deficits when the economy is good, is the idea of counter-cyclical fiscal policy. All right, that was a lot more market update than we usually do, but we've had a lot more stuff in the market since we talked last. So that's that. And we did, like I said, get a question from Jeff this time. He wanted to know about how to enter bull put spreads, essentially how to use the options at the same time. He uses the E-Trade app and hasn't seen how to do it. Let's see. All right, and then also some stats about how many of those spreads had problems during this downturn compared to before. All right, so how to enter them. I don't have access to E-Trade. I just don't have an account there. But the gist of it is you're looking for, it's usually called a spread ticket. Sometimes it's a multi-leg order ticket. That's the kind of thing you should be able to ask somebody at E-Trade, possibly. Like a online chat, they should be able to point you in the right direction. And then what you're going to enter is you're going to enter the information about each option. So typically there's a box at the top that says, what is the ticker symbol? You're going to put in the stock, and then you'll enter the strike price and expiration date, and whether it's a call or a put for each of the options you're trying to buy, or in this case, sell one and buy one. So you'll enter, right, like strike price, strike price, expiration date, whether it's a call or a put, whether you're buying it or selling it. But then instead of entering a price for each leg, you're going to enter one price at the end of the trade, and that is the net price you want to get for the transaction. So let's go over here, and we'll look at an investor's keyhole trade and talk about what exactly that price is. All right, so in this case, look at the April 14-16 bull put spread for 20-cent credit or better. So we're going to sell the 16, we're going to buy the 14, and the net cost, right? So we bring money in for selling the 16, we pay for the 14. The net cost of those two transactions is 20 cents. And so the reason to do this is you keep from having to sort of try to do two independent transactions to get one price. Like what we care about is 20 cents. We don't really care what we pay for the 16 or the 14. What we care about is 20 cents. Yeah, that's how you do that. All right, so Preston says, just sort of click sell the option you want and then click add an option leg, and then pick the same expiration, etc. And that's how you do it. Thank you for that, Preston. But yeah, apparently there's a add option leg to the selling an option screen, and you just add it from there, and then you can put two or more things on the same ticket. And yeah, make it a limit order. In this case, it's limit credit. On diagonal spreads, it's limit debit, because you do care about the 20 cents. You don't actually want to do this for 15 cents. You want to do it for 20. And so that way you'll get filled at 20 or better, but not worse than 20. And then we have had some other questions about bull put spreads, so I figured I'd go over the sort of basics here. And so yeah, this is one of those weird option charts where both axes are dollars, but the horizontal here is strike price, or is stock price, and the vertical here is the P&L of your trade. So at the point of the short strike, right, that is, you're essentially betting that the stock will stay above that price. So if the stock stays above that, both options expire worthless, you keep your credit. Once the stock drops below the strike price of that sold put, you are now potentially obligated to buy the stock at that price. And so your break-even point is that strike price less the credit you got for selling the trade. So in the example we just looked at where it's 16.14 for 20 cents, this is 16. This break-even point is 15.80. Okay, and that's 16 minus the 20 cents. So we break even at 16.80 because we buy the stock for 16. We already got 20 cents, so we're actually right. We start to lose money below 16.80. All the way down to 14, where we have the right to sell the stock for 14. So the worst case scenario is the stock drops below 14. We have to buy it for 16. We got an initial credit, so we're really only out 15.80, and then we're allowed to sell the stock for 14. So even though the stock goes to zero, we can sell it for 14. We're only on the hook here for $1.80. And we're trying to get a profit of 20 cents in this case. That's all per share. So that's how this works. And then you may start to see some call spreads, which would be basically just the same thing in reverse, and that would be a bear call credit spread. But it's the same basic idea. You sell the one that's where the strike price is close to the current price. You buy one further out, and you get a net credit for doing that. And then, so stats in terms of how things have happened, how things have gone between this downturn and last turn. In the Investors Keyhole service, we use the monthly expirations. We're not doing weeklies there. And literally, we haven't had a monthly expiration since the market went down. February expiration was the 19th or something like that. And so we haven't checked. We just we don't manage those trades, so we just check at expiration to see who are the winners and who are the losers. It won't be particularly good, but the win rate over the lifetime of that service, which dates back to 2002, 2004, something like that, is 89%. We had several months earlier this year and last year where the win rate was higher than 90. But this month I don't expect to be particularly good. But we went from record highs to a bear market pretty much in record time. Don't know that that's a record to be particularly proud of, but it happened. So again, right, like this is another thing where we've been like, oh, well, as the market has deteriorated, I can tell you that, because it's deteriorated between expirations. We were at all-time highs last time through. This time, down 20%. So I don't expect it to be a particularly good month for the Investors Keyhole trades. And like I said, we may start looking at using some bearish trades in there occasionally. But I can't actually give you the results in between expirations because we don't keep it like that. All right, so that is the prepared remarks. Any other questions you have, you can put them in the question box there, and I'll be happy to get to it. We got a question from Ted a little bit earlier who wanted to know how to access and edit a watch list. So let me bring the site back up here. So you can get to watch lists from, it shows up a bunch of places. So it shows up here, this little down arrow you can click on. And then I think if you go to a stock page, you can edit your watch list. Well, you can at least add to, you can add to your watch list from here. You can select it, right? Boom. Okay, so that adds it. You can take it off like that. And so if you hit the add to watch list button, you can make a new watch list like that. And you go over here. You can delete the watch list if you want. That's how it does. Then the watch list shows up like on the stock dashboard and on the individual stock pages. It gives you an idea what's going on with your stocks on a given day. All right. Yeah, those are the questions we got so far. Anything else you have? While I'm waiting for more questions, this session, like all of our workshops, is being recorded. We'll post a video and a link to the slides probably tomorrow morning, and we'll send you an email when that's ready to go. Yeah, if you have questions at any point, you can always use this help button. That sends us an email, and we get back to most of those pretty quick. If you're just on the site between workshops, by all means, do that. You can also give us a phone call. We're here between 8 a.m. and 5 p.m. Eastern Time. Yeah. All right, so Donald said, what is the best way to just do straight up calls? We don't have that as a strategy on the website here. And there are any number of ways to approach that question. It really sort of depends on what it is you're trying to accomplish, Donald. I mean, in a market like this, in a market like this, you're probably looking at puts. Although maybe you want to look at trying to catch some bounces here and there. You could buy relatively short dated calls in that case. And you could buy them in the money where you're a little bit less likely. Yeah, your percent returns are a little bit lower, but you're a little bit less likely to lose 100% of your amount invested. Whereas, an out of the money call functions a little bit more like a lottery ticket in terms of, when people talk about making 400% on a single option trade, those are typically going to be out of the money calls. And yeah, you can make 400% in a single option trade. You can do better than that, but you also lose 100% of your investment, some amount of the time. And so really it depends on what exactly it is you're trying to accomplish in terms of like, do you just want to make a bet that the whole market will be higher in 6 months? Are you trying to take advantage of intraday volatility? If you're trying to do that, you may look at, just weekly options. If you want something longer term, then what you make, if you want to make a bet about where the market will be in June, what you might want to do is buy a January call. And the reason to do that is if you buy a June call to bet on where the market will be in June, that's a pretty binary bet in terms of it'll either be there or it won't. And if it's not, all your entire investment is gone. Whereas you buy a January, time value hasn't, the loss of time value hasn't taken all of your money away. And so you could hold it for a little bit longer than June if you wanted to. But also you're going to make, in that case, you can make money if the market goes up, even if it doesn't go all the way up to your strike price. A thing that people can forget about options is you don't have to hold it until expiration. You can sell it ahead of time. And so if you want to make a bet that, the market will be here by a certain day, you can certainly try to buy an option that expires that day. But if the market isn't at your level or higher than your level, you just lost. Whereas you can buy an option that expires in January, and then there's nothing stopping you from selling it in June if the price is higher. So that's another sort of thing to consider. As far as how to do that, there's a ton of ways to do that in terms of out of the money, in the money, long term, short term. It really depends on what exactly the bet you're trying to make is. All right. but yeah, if there's more questions, by all means, put them in there. Our next workshop will be 3 weeks from today, which is April 1st. Yeah, so we'll send out an invitation ahead of time, and there'll be a link to sign up in the email that goes out tomorrow. You can always, you can sign up early if you want, and then go to webinar. We'll actually send you an email, letting you know the workshop is about to start, and you can just come in there. But that way, you're guaranteed to get that reminder. You don't have to try to register at a later date. All right, so Donald said he does enjoy the unusual options activity emails. And let me point out here that if you go to the options dashboard, under options news here, there used to be. We're currently changing the way some of our news is, yeah, here we go. We're changing the way some of our news gets displayed, so things move around a little bit. But we do periodically, our news provider, MT Newswires, does move some option stories periodically. And so, yeah, they'll, give you these things as they change. And then there's another one down here too. Yeah, they'll give you some other, oh, that one doesn't look like it actually had anything about options. But yeah, there is some additional option content on the site, and we are working on sort of redesigning the way some of the news is displayed to make some of that a little bit easier to find also. Yeah. All right, so if there's not any more questions, I'll go ahead and close up shop here. Like I said, we'll send out that recording tomorrow. Next workshop's in 3 weeks. Don't hesitate to get in touch with us if you have questions about the site or, something else. We're always happy to help. Until April 1st, though, I'm going to go ahead and sign off. Thank you all for coming. And yeah, good luck.